All right, welcome to today's webinar, everyone. Thanks a lot for those of you who are here on time. Really, really appreciate it. We will wait 1 or 2 minutes before we get started. So if you have any last minute bathroom break runs or water cup refills like I might go and do right now, go and do those, and then we'll start right around 12:02 Eastern. All right, it is 12:02, so let's go ahead and get started. Welcome to today's webinar titled Inside Private Lending: How Investors Earn Income While Solving Real Housing Needs. And our presenter today is Harley Green from InvestAway. Before we move one step further, we got to go over our obligatory disclosure to keep the lawyers happy. So, in all seriousness, this presentation is for educational purposes only. Plan is not a tax advisor or an investment advisor. So, if you are going to make any investment or tax related decisions, please do your due diligence and go seek out the advice of the appropriate professionals. Also, a housekeeping issue: the chat will be turned off as always, but the Q&A function will be turned on. And I checked with Harley before. He said, bring on the questions, ask him in the moment. He wants to answer them in the moment. So let's make this a dialogue. And please, no question is too big or too small. So please ask your questions as we're going through the presentation. And then finally, if you have any questions about the presentation that don't get covered, or you have any self-directed IRA questions, please reach out to me directly at my contact information, and you can always schedule a call with me using that QR code. So without further ado, I'm going to turn it over to you, Harley. Let me stop sharing. The floor is yours.
Slides here. All right. So the best real estate returns of our lives actually started the day that we stopped buying houses. I'm Harley Green. My wife Adrienne and I spent a decade doing flips and rentals, and then we found out the person financing the flip can do better than the person swinging the hammer with none of the headaches of tenants, none of the contractors, and a recorded first lien position securing every dollar. This is going to be a quick look at how that works, what it has actually paid, what goes wrong, and what we do about it, and then how to tell if private lending is a good fit for you. So first, you should find out who's talking. So a little timeline for us. We started investing in 2013, doing flips, burrs, and eventually we had holding. In 2022, we started lending our own money after seeing good deals get killed by poor communication and changing terms from other lenders. So in 2025, we launched InvestAway. Here's how it all matters. We got started with our own capital using self-directed IRA, just like Plan. It's a great way to get into private lending, tax advantage vehicles, and is a good way for people that have capital sitting idle to earn solid returns secured by real estate. And we learned some tuition that I'm going to share some of our lessons learned with you today. Back in 2022 and 2023, we put over $500,000 of our own money from our self-directed IRAs into second position loans. And we're still waiting on that money today. That was our tuition. It bought some expensive lessons learned. And here are the three rules that we've learned that we never break going forward. First, we only take first lien positions. We never lend more than 75% of our own capital against a conservative after repair value or ARV. And our own capital funds every deal first before anyone else. So everything you're going to see today's presentation is because of those lessons that we've learned, the protections that we've built in, that we wish someone had taught us before we got into private lending. So with those scars and that tuition that we've paid, here's what we see in the market that most people miss. So many of you may know that starter homes are disappearing, and the houses that exist are aging faster than anyone can renovate them. The photos kind of show this here. It's the same house before and after. Somebody has to fund this work. And the thing is, it's not going to be a bank. Banks are too slow for active flippers. They can't manage the draw schedules. They underwrite W-2s instead of deals, so skilled local operators are starved for capital, and the work piles up. Here's what that means for people with self-directed IRAs. The pricing that you can earn as a private lender is service-based. Borrowers pay for speed and certainty of the funding, not the Fed's opinion on what rates should be. So we don't chase rate cycles or need the market to be timed at all. The collateral that we lend against is the house, and it's a house that you can drive past, not a ticker on the screen. And if you've ever been part of a syndication or fund that suspended its distributions, you already know why that matters. So that's the theory. Here's what actually happens when we put our money against it. Over the course of our lending, we've lent out over $10 million of our own personal capital. This has been across 50 different loans, and 28 of those have repaid in full, while 22 are still working right now. The line that I'm most proud of is the one at the bottom. Every single one has repaid in full to date, and every dollar and principal of interest with it to our lending partners. So that's our historic record. It's not a promise, and of course, past results don't guarantee anything, but 4 years of this track record is not luck either. It's the box that we'll get into in just a minute. So part of how we do what we do and how who we lend to is probably not who you'd guess. We underwrite the deal and the property. We don't look at a W-2. We don't look for a perfect credit profile, and it's not about who you know. Because for us, the loan is protected by the house and our own conservative numbers. So we can say yes to skilled operators that are locked out of financing from traditional banks. And the result is that they come back. More than half of our loans are repeat borrowers, and our two most active borrowers have done 8 and 9 loans, respectively. Another special number is over 40% of our active loans fund women-owned businesses. In renovation lending, that makes us a big outlier. And it's not a charity. It's just what happens when you underwrite the deal instead of the resume. So every one of these loans takes a house that's got a kitchen like this that you see on the right and turns it back into someone's home that they can be proud of. You can feel good about what your money is doing because it's earning good returns while doing good in the community. So what does this actually mean for you as the capital contributor or the lender? So there's 5 things we want to talk about. How your money is secured. It's recorded against a first lien on a specific property, and the commitments are short. Oftentimes with these fix and flip loans, the terms are 4 to 9 months so that you have access to your capital in a short time period. There's no long lockups. On average, we've seen with our fix and flip loans a typical length of about 6 months. The typical net return to the investors is around 12 to 14% per loan. Across all the completed lending partner positions over the last year, we've seen an average of 15% plus. That's because of extension fees that get passed through. And that's common with these short-term loans is that because they are short-term and they're fix and flips, there's lots of surprises. So extensions are not something to be worried about. It's built in and it's a way to make additional returns while you're being a private lender. The nice thing about working with a lender like Investaway is there's no fees. It's not like a fund where there might be management fees or things that come out of your capital. We only get paid when our investors get paid, and it's all coming from the borrower. The borrower pays the interest rate and fees to us, and we pass that on to our lending partners. So the numbers on this slide can be easy. Let's look at an actual loan in a real deal here. So on the left side first, This is a loan that we lent on 1088 Bridge Street in McMinnville, Tennessee. The operator bought it for $40,000, had a $35,000 renovation budget. We loaned $85,000. Now, we didn't give a check for $85,000 up front. We fund the initial purchase while the borrower brought a down payment. And one thing that we do as a private lender that sets us apart, and you can consider if you want to do private lending, is rolling the closing costs into the loan. It helps you deploy more capital, which you can earn more interest on, and really sets you apart, making it easier for borrowers to get into deals while they still have skin in the game with that down payment. Again, where the total loan amount is still capped at that 75% of the ARV. And that ARV that we came up with on this property was $113,000. And that's one of the things is because we've been active real estate investors ourselves, we're very good at getting the assessed value of the property after renovations by comparing what the scope of work is and what the market is doing. So we always take our number and not what the borrower gives us. So that way we're always conservative with that result. This one was the first loan this operator had done with us, and it was actually their first flip because they had been locked out of traditional financing due to some things on their credit from medical debt. It was a woman-owned local operator. She came to us, shared the situation. She's been active in real estate for a long time as a wholesaler, so she knew what to do. She just couldn't get someone to fund her. So we helped her with the financing. She repaid the project in 3 months. She got in there, started doing the work immediately, and was on to the next one. Since then, she's come back 4 times to successfully doing flips with us. And that's exactly what a good borrower relationship looks like. Now, on the right side is what it looks like for the private lender. So this partner put in $50,000 up front. On the loan, their net rate was 14%. We were charging the borrower 16%. Just after 176 days, it repaid and they earned $3,900 plus. They rolled that whole 53,000 plus into that same borrower's next loan. That's one of the cool things is you can track the different borrowers. If you have one that you like, you can always follow them. And when there's a new loan, you can go into that loan with them. Just 73 days later on that second loan, it repaid and they got another 14, almost $1,500. Again, they rolled that into a third loan with the same borrower. And over time, that $50,000 quickly turned into $55,000 of with interest and extension fees. So now we can talk about kind of what's the machinery behind all of this. How does this work? So with private lending, you fund a specific loan. You're not in a fund. You're not getting your money pooled together. Every dollar that you place is tied to a specific property, a specific note, a specific lien. So let's say that there's a loan for 100,000, and this is the situation if you want to partner with Investaway, you can come in and put, say, $100,000 on it. You will now own 50% of that note. Part of that is you're going to have a co-lending agreement and assignment interest. And what's nice about that is that you have a note, a deed of trust that are all recorded at the county level. So if anything were to happen, you have the assignment of interest, the note and deed of trust that you can take as security for your investment, stronger than any kind of shares in a fund or syndication. So mechanically, the way it works is you select your loan, you e-sign the agreement, we give you all the documents, you wire your funds, and that's it. You earn interest on it, you get monthly updates, and it pays off. All your capital interest is returned and choose to either redeploy that into a new loan or take it to do something else. So now the thing I like to talk about is the alignment of interest. This is what I feel really sets us apart in our private lending. Every loan that you see, if you're working with Investaway, has already been funded. We do not go out and try to raise capital after we get a deal and like put investor capital in a deal before our own. That's not how it works. Our capital goes in first, whether or not a lending partner ever joins us. So there's no raise, there's nothing to fill, and there's no pressure for us to sell anything to investors. A partner who lends with us is simply taking part over what we already funded, so the interests are fully aligned. We're paid only after our lending partners are made whole, and there's no fees. The only difference is that we charge origination points. So the borrower pays that when their loan's originated, and then we just take a 2% of the interest for servicing the loan during the life of the loan. And then if our underwriting was to be wrong, our money is in the loan with all of our lending partners, and our lending partners get paid before we take a penny. So here's the box about, we can talk about the underwriting now and how all the capital is protected with private lending and some of the lessons that came out of our experience when we got started. So every single loan that we process comes through with the same underwriting process. There's no exceptions. Everything is going to be a first lien recorded with the county with full lender's title insurance, hazard insurance, and if it's in a flood zone, flood insurance. We never lend more than 75% of against the internally underwritten after repair value. And again, we don't use the borrower's numbers. We want to make sure that we're getting that number ourselves. We only lend to business entities. So this is something that's really important. A lot of first-time lenders get hung up. They might have a friend come to them and say, "Hey, can you lend me money? I want to buy this house for myself or like renovate it." There are a lot of regulations involved in lending to personal primary residences. So you want to be very careful about that to focus on business entities only and that you're doing a business purpose loan. As far as the insurance goes, one thing that sets us apart is we require 125% or insurance coverage of our loan amount. And that's because if something were to go wrong, we want to make sure all of the interest that accrues, late fees, legal expenses, recovery expenses are all covered and that we're made whole for both us and anyone who is lending with us. Every loan that we originate is prepared by a private lending attorney. So that's another mistake that a lot of private lenders start with. They just say, hey, maybe the title company attorneys can drop the loan documents, or I'll use ChatGPT to make the loan documents. Please use an attorney to draw these up. It's not expensive, and the borrower pays for it. So it's nothing out of your pocket. This way, you're getting state compliant documents for every single deal.
Harley, can
Then
I
here's the other thing that,
interrupt you
yes.
for a second? You mentioned that you have your Investaway has its own capital in these loans. Is there like a certain percentage of the loan that's always carried by Investaway along with the investors?
So that's a great question. So we don't have a hard rule on that because we do have some situations where our private lenders will come to us and say, "Hey, I love this borrower. I want to fund their whole loan." So we allow that. Now we are involved because of the co-lending agreement in the management of it, and we do have upside that it have a vested interest in making sure that loan performs. And so we do continue managing all the loans, even if like our capital is replaced. And we do use a loan management software that has offerings and shows how much has been raised. So people who are like, hey, I really only want to participate in a loan if it's like, 50-50, they can pick and choose that way
Mm,
from the investor portal.
cool. All right, thanks.
Great question. All right. So then one of the other pieces about protecting the capital here is the picture on the left of the slide here. So a lot of lenders, they might fund the loan and then they just give the borrower like a 50K check and say, okay, hey, go do your renovations. Let me know when you're done. That is not how we operate. We only fund renovation work for completed paid work. And so one of the things it looks like is this photo quad on the left when someone wants to get reimbursed for work, they have to submit evidence. So they give details showing the work is completed on the house and that it's been paid for with receipts, invoice, and if they pay cash, we need to see bank statements. We'll also sometimes collect like W-9s and insurance certificates from contractors if they are paying with cash so that we make sure both our capital is protected and our borrower is protected too from getting mechanics liens and things for not paying for the work. So the other thing that I want to talk about too is like the ARV. A lot of people kind of get confused about how the ARV works and how the money is protected by that equity cushion. So an example down at the bottom of the slide is showing there's a $116,000 loan with a $155,000 after repair value. In this situation, when that property went to sell, it actually sold for 184,500. So that meant that our original kind of conservative underwriting, putting a 25% equity cushion, actually was like a 63% loan to value instead of 75%. And that is intentional. When we do our ARVs and get that estimated future value, we're looking backwards. We're looking at sold comps in the past. And we like to lend in high growth markets, plus benefiting from time, plus benefiting from the forced appreciation that the borrower is doing to the house through those renovations. So it's very common that when the loan goes to pay off after that 4 to 9 months, it's actually worth like 20, 30% more than we estimated. And that's fine. It protects our capital even more. So we've kind of talked about the protections. Now I want to show you a slide that a lot of operators don't like showing people. And that's what happens when a project goes sideways. So with fix and flips, oftentimes the renovations run long. About half of our loans end up extending, and that's okay. It's baked into our model. The first extension is already defined in the loan terms, and so when a borrower comes to us and says, "Hey, look, something unexpected came up. The septic needed to get replaced. We weren't able to inspect it when we purchased the property." That's okay. We can analyze the situation. We can do a quick refresh on the ARV, and if everything looks good, we just charge them an extension fee, give them another 3 months to exit without pressure. And the great thing for us as the private lenders is that we're able to get that extension fee and pass it along to people who are lending with us, which results in a 1% boost of the principal. So, for example, if someone was invested 100K on a loan and it extends 3 months, they're going to get $1,000 added to their position paid by the borrower that then continues to earn interest for the life of that loan. And that's how we've resulted in having lending partners earn like 15% annualized, which is higher than the stated note rates that are typically in like the 12 to 14% range. Another thing to kind of talk about is technical default. So this means that a payment is more than 10 days late. And this has happened. This is, not uncommon. There are situations both where like a borrower might just like forget to make the payment, things like that. That's okay. We reach out, let them know, remind them, and every time that's happened, we get a wire that day, get paid. Or there's situations where it's close to the loan being paid off. They are under contract, and if anyone has bought and sold real estate before, buyers have their own challenges with financing and their lenders. And so there are times where like the closing date slips, and sometimes it'll go past the loan maturity date. As long as we're in good communication with the title company and our borrower and understand what's going on, it is often cheaper to the borrower to just say, hey, we're going to switch default on. You're paying 20% interest for like 5 days. That's going to be cheaper than them having to do an extension and pay that full like 1 to 3% extension fee. And that's okay. Now, there are situations where it's possible a borrower cannot finish the flip. Maybe they ran out of money, they've got health issues, all kinds of reasons. So the nice thing is we are active real estate investors or have been for many years. We'll come alongside them and coach them. We might say things like, maybe you need to like change your scope of work. Have you switched contractors? We can recommend a contractor because we're lending in markets that we're familiar with. We can say maybe you need to get a new realtor in there and get a different listing strategy. We've done these products ourselves. We know how to help them get out of it. Sometimes they need more money. Oftentimes, our loans, when they originate, are at like 60 to 65% of the ARV. So there's margin there to just give them additional renovation funds. We can do a new underwriting, we can do a loan modification. It's costly to the borrower, but that cost still allows them to have that safety release valve and get the time and money they need to exit successfully. If those things don't work, part of what we do, and I recommend anyone else who's doing private lending, is include a deed in lieu clause with their loan documents. You can have your attorney draw this up, and we have it standard on all of our loan documents, which this basically means the borrower has pre-agreed when they sign the loan documents to give the deed to you as the lender in lieu of foreclosure in the event that they are in a default situation and distressed. Now, they may not honor that, and that's okay. We have the first position lien as a backup, and the attorneys who make our loan documents will then take care of doing the foreclosure process. And one of the things that we do at Investaway to help facilitate this, and we've never had to do it to make it in case we needed to, is we primarily lend in states that are non-judicial foreclosure states. And this varies state by state. You can talk to your attorney about which states these are. And what we like about that is that it's more of a procedural process to do a foreclosure versus a hearing and a long drawn out judicial process. And so that means if we ever were to have to do a foreclosure, we could get that property back in some states like Georgia as little as 30 to 60 days, which compared to states that are like judicial foreclosure states, it could take 6 months. So that means we get the property back quickly, and then we can have a plan how to finish the flip. And this is where our private lenders with Investaway, they actually get a say in things. So they are partial owners of that note. It's been assigned to them. In the case where there was a situation where we had to foreclose, we took over the property, we're going to present a couple options like, okay, we can sell the property as is, or we can take a couple more months, finish the renovations, and sell it at retail. And then the members who are invested on that note will vote, and whatever the majority is based on ownership, that's the plan that we'll execute on behalf of our co-lenders. So another question that often gets asked is, what happens if something happens to Harley and Adrian or Investway? It's a fair question. One of the nice things about private lending is it has allowed our family to travel full-time internationally. I'm coming to you right now from Antigua, Guatemala, and we primarily live outside the US. So this is a really good question to ask. And the nice thing about our model is that the lien is recorded in the county of the property where we lend, and it stands on its own no matter what happens to us. You have that assignment of interest document. You get a full copy of the note and the deed of trust. So you have the full executed original documents to protect you. And then the other thing is we also take care of what happens if something happens to you as our co-lenders. If you pass away or become incapacitated, we already have built into our co-lending agreement that your investment automatically passes on to your state, and we don't charge any administrative fees for this. There's no additional consent needed. And then if something does happen to us as well, we have interim management succession plans in place that's managed by our trust to help wrap things up and get everyone their capital back. When an investor onboards with us, we automatically ask for their disbursement account instructions. So that way, if a loan pays off and we can't get a hold of you, we just wire the money right back to you. So it would be something like, hey, here's the disbursement account instructions for Camel Plan. That money just goes right back. It says what their account is, and it goes right back into your IRA. So how does this compare to other all the different ways of being a private lender? And I want to kind of walk through like the three, main options here. So all these are very legitimate ways of doing it. Number one is you can do it yourself, and this works if you've got time on your hands, you want to have a second job. You're going to be doing all the underwriting, finding the deals yourself. It can be very profitable. We love it. The other option is a debt fund. There are debt funds out there where you're fully passive, your money is pooled together, and they just go out and they fund loans. These often come with higher fees and lower yields. The other option is partnering with an existing lender. So you can find someone like Investaway, where it's this nice hybrid approach where you get to pick and choose the specific deals that you're invested on, and you have the specific interest in the note. So that way you have a lot more control. You've got the real deed of trust and note assigned to you based on your investment. And you're going to get a nice higher return. One of the things that we've structured is rather than doing like monthly dividend payouts, we are able to just have the investors participate on the specific loan and get paid when that loan pays off. And because that lowers our administrative costs, we pass along higher returns. So the other thing to keep in mind is that because these are, the 4 to 9 month loans, the lockup period is just 4 to 9 months, maybe plus some extensions, versus like a lot of funds require you be in it for 4 to 5 years before you can get your capital back. So one thing a lot of people ask about is if we do want to be a private lender and still have cash flow, especially maybe you're in retirement, you've got your self-directed IRA and you're relying on it to have cash flow to fund your lifestyle, there's a way to get that set up. I call it the loan ladder. And so you can do this yourself. You can do it with Investaway as well. It takes a little bit larger allocation, but the amazing thing is with the returns that you get as a private lender to get a decent lifestyle income, it doesn't actually take that much. It doesn't take millions of dollars. Here's a 500K example here, where you can take 500K, split it across 4 different loans with staggered maturity dates, and then you can have cash flow, capital liquidity events every month or two as those are paying off. And then you can decide to take the interest back, use that for your lifestyle expenses, or roll the rest or some portion into another loan that has now got a further out maturity date and just keep building on that ladder. So you are able to have effective regular liquidity while still being in investment vehicles that are 4 to 9 months in length. So let's talk about who this kind of lending might actually be for. Most of our people that we find do private lending are in kind of two buckets. The first are people who have experience with real estate. They like the asset class. They've owned rentals, they've flipped houses, but they're just done with all the tenants and turnovers and contractors. They want to still be in real estate as an asset class for their investing, don't want to have that direct exposure of the direct ownership. The second group of people are, high income earners. They've got retirement accounts, and they'd rather have their money rebuilding neighborhoods that they can drive through and see, secured against real houses, instead of feeding people on Wall Street. So the practical fit is this. If you've got about 50K that you're able to deploy on an individual loan, and you're comfortable with that 4 to 9 month term, without having that liquidity come when those loans pay off, you can do it whether it's with your personal cash or with the self-directed IRA. The self-directed IRA is again ideal for this because with loans, it's not like real estate where there's depreciation and things. It's just straight interest income. So having it in a tax advantage account like a self-directed IRA is a perfect investment vehicle for this. I'll say for Investaway specifically, we work with a small group of lending partners, and we do prioritize our new loans that we originate to our existing partners first. And so here's how that kind of fits in. To make it really easy, I have 3 examples here of actual loans that we have on the books right now. The first one is under $20,000 loan in Tennessee. It has a 66% ARV or loan to value ratio from that ARV. The net interest rate to investors on this one is actually 13%. Going down the list here on the far right, this one was kind of a unique situation where generally we would not prioritize Florida as a state to lend in. However, this operator came to us well referred from an existing investor, And what their strategy is to take these luxury homes and like do nice renovations on them and turn them into Airbnbs. And so we were easily able to verify their track record with other homes they've purchased against their Airbnb account and see that yes, this is a legitimate investor. They've got a great strategy and it's a great payoff and opportunity for our co-lending partners. So that's pretty much how it works. This is what it looks like on our investor portal. You get all the details of these specific deals. You can choose which ones you want to participate in on your own timeline. There's no pressure. And if this is a something that you're interested in learning more about, or you want to get started on your own, I'm more than happy to have a call with you. You can scan that QR code. You can go to investaway.co/calendar. I am always excited talking to other people who do self-directed IRAs and want to get into private lending. Thank you,
Very
Matt.
good. Well said. We had some questions come in and wasn't quite the right moment, so we're here now, so let's ask them. I'm actually going to go in the reverse order that they came in. The first one was, or I guess the last one was, do you ever split the loan among two or more investors, or is each loan only shared with Investaway?
Great question. So on our lending portal, it'll show the allocation total that's there. It does not break down number of investors. So it could be one, it could be many. We do ask for a minimum of 50K per investor for loans. So you can kind of back out like potentially what the max amount of other investors are. And again, what that usually drives to is like, where's the priority of my money? That's kind of the underlying question, I think. And we prioritize our capital partners first. So if that loan ever was to go into default, the money is going to flow to our lending partners before Investaway gets paid on the capital and interest that's owed.
Yeah, and I think another I definitely think that the sort of underlying question that you just sort of brought up to the surface is true. Another thought would be like if you have a $500,000 loan, for example, and one person invests 50K and then someone else invests 450K and that loan goes sideways, that investor, the 450K investor, to my understanding, is going to have more voting power in kind of the in and how you solve that loan. Is that correct?
That's true. So in the event that there's like a default and we have to take over the house, the investor that has the largest gets the largest voting control. Now they did not get paid first; they would still get pro rata payment back. And the nice thing is I'm a mastermind with other hard money lenders, and some of those lenders that are much larger and have gone through more foreclosures, their experience has been that when they go through a foreclosure, they net more money. It sounds kind of backwards, like you're, oh, it's stressful, but what really happens is because of the equity cushion, because we are conservatively lending against an after repair value, what we typically see stress is at the end. It's already been renovated and it's just they kind of screwed up the renovation somehow or the market's shifted, they're not getting the amount they want, but the house is done and it's in a saleable condition. Our loan is sitting down there with, max of 75% of what that value is. And it's again, that value is typically a more conservative value because we're looking backwards. So once we take over that house and we go to sell it, we can drop the price more than 25% and still be whole. And so going into a foreclosure situation with private lending, while it is going to add time, it actually does not reduce returns in our experience.
Okay, awesome. Another question from this person was, how many loans do you have now, and how many are late? Like, what's your default rate? And is that number increasing in this market?
Good question. So we have 22 active loans on the books right now. They're all in good standing. We have zero in default, and we've never had to go to foreclosure. Now, we did make four extensions last month, but that again, that tracks with our historical track rate of about 50% of loans getting extended. And many of those were because they were under contract and like a borrower's financing got delayed or fell through. We had a deal where a borrower was refinancing and they chose a 5-month loan term with us, but their refinance lender required a 6-month seasoning time period before they would refinance. So it wasn't like the deal was bad or the value was bad. Their, excuse me, their exit lender just required that they own it for 6 months before they'd refinance. So they had to do an extension. We made another 1% on that loan. It was a large loan. It ended up being like $15,000 for doing nothing, which is great as a private lender.
Perfect. These other questions, they came in, I think they're more like self-directed IRA questions. So, but they totally relate to this. So we'll tag team these. But this person asked, um, The most confusing thing about self-directed IRAs is, quote, you cannot add sweat equity. What does sweat equity include? I am investigating the investment, making decisions on buy or sell, increase. Are these sweat equity? Okay, so great question. And this sounds kind of more like this person is looking at actually owning a real estate. So sweat equity is not what's written into the IRS code. The IRS is actually says you can't furnish services for the property. So what does that actually mean? Like in practical, in practice, you as the IRA holder, you can review the property. You can look at the property. You can look at the financials of the property, and you can look at things about the property to inform whether you want to actually buy that property. So that's all. You can do that yourself. You don't find a service to do that on behalf of your IRA. You can do all of that due diligence yourself. That's totally allowed. It really comes down to when you make the decision to transact on the property, so send funds over and you own that property, then you cannot go in and repair the kitchen sink yourself. You cannot manage the property. You can't advertise the rooms to do a lease up. So when there are services to be completed to improve the property or to collect rent on the property, things like that, you can't be doing those. You need to have a third party, like a property management company, who's handling all of that. But anything leading up to the actual like decision to buy the property, or just if you're like to your other question, if you're looking at like different investment opportunities, you can look at all of those yourself. That's totally fine. But um, anything having to do with like the management of the property itself, it needs to be done by a third party property management company. And so to kind of segue this actually into Harley's presentation, he touched on this, I think it was a couple of slides ago, about like who is this strategy for. A lot of real estate investors who own property outside of their IRAs, they get excited about the fact that they can own property, real estate inside of an IRA because they're used to that asset class, but they're used to maybe managing it themselves or doing the construction or the improvements on it themselves. So it's sort of like a roller coaster of emotions sometimes. They're excited about the asset class, and then they're like, oh, wait, there's going to be all these like rules um, that prevent me from providing the sweat equity that I normally can provide. And so often, not all the time, but there's a pivot into lending because lending, they can't, the lending gives them the ability to lend on the asset class that they're used to, but they, they're, they're just a lender. So they're not the landlord or anything like that. So I hope that answers your question specifically about owning property through an IRA. When it comes to a loan held inside of your IRA, it's sort of the same thing. Like you really shouldn't be servicing the loan yourself. If the loan goes into default and if you have to like start paying for insurance or anything like that because the borrower uh, stops paying insurance, that needs to be paid from your IRA. So the servicing also needs to be happen by a third party. So a lot of these platforms, like what Investaway does, they become attractive to IRA investors because that arm's length requirement that the IRS has in place um, is by virtue of it being a platform that's basically providing all those services already. It's doing that for you. So that's again not endorsing anything, but just sort of like structurally, I think that's sort of how platforms like Investaway check all the boxes for anyone who's concerned about anything being considered self-dealing or the sweat equity question. Anything you want to add there, Harley?
You nailed it.
Cool. All right. Good. So let me check off some of these. This person also had, do you lend to buyers of BRRR for down payment and quick improvement support?
So great question. This kind of goes into some. advanced deal structuring. A lot of times people will want to get like seller financing, wraps. There's like, Gator method and other terms out there for this kind of different financing approaches. What we like to do when we talk to those types of borrowers is say,
Oh, sorry,
let's
Harley.
get rid of
Harley, I'm
all
going to
that
jump in.
complication and headache.
I'm going to jump in for a second.
Yeah,
Because it is kind of complicated. Can you unpack it a little bit before you go into it? Because a lot of people may not know Gator financing. That's a new one to me. Is that like something done in Florida? You know, ha
sure.
ha ha ha. Yeah, go ahead.
All right. So yes, so the bird strategy is buy, renovate, rent, refinance, repeat. So it's a strategy for real estate investing where investors can basically get all their equity back out from the down payment and keep building up a nice real estate portfolio quickly. And then the Gator method and these other advanced strategies are where you negotiate different financing terms directly with the either take over their existing loan or maybe you do seller financing, things like that. What I like to do is just simplify everything. And a lot of borrowers come to it, like they've got all these grand ideas of these complex methods, and it doesn't have to be that complicated for them when you have the right lender. And so that's why we've structured the loans that we operate to be what we wish we had as active investors. So that's why we'll do things like only require 5% down of the purchase price. So again, you're still bringing about what you would have anyway to entice a seller to do this kind of advanced financing options. We can roll the closing costs into the loan and then provide 100% of the renovation funds. Because at the end of the day, when you are doing these BRRRR methods, you have to add value, and that takes capital to do that work. So rather than going out and trying to like raise funds from other people, getting them into these second positions, which a lot of people are hesitant to get into and are kind of risky, just deal with one lender. And so that's what we try to do with our borrowers. Say, like, let's just keep it simple, fund everything for you. You'll get a clean exit and you'll actually net more money that way with a lot less headache.
Perfect. Then another question is, what is the investor reporting practice? Monthly updates. So, like, what's the cadence of reporting on the loans to your investors?
Yep. So we send out a very detailed monthly email to all of our lending partners, full status of the like, number of loans we've done, volume, new investor capital. And we also share issues. Like I shared in this last email a couple of days ago about how we had to extend 4 different loans, went into real detail on 2 of them and the reasons why. And then on any loan that is in distress, we are required by our co-lending agreement to give specific updates on that to the co-lenders on it. So in general, if you don't hear anything other than that monthly update, your loan is fine. It's in operating condition. And then we also have an investor portal where at any time you can log in, see the status of your loan and investment, and you can also get monthly statements from that.
Perfect. And then a question I had was actually going back to the loan ladder that you mentioned. And the slide before that, you basically had you kind of were comparing three approaches to private lending. There's DIY, which is like fully originating the loan, finding the deal, all that stuff, all doing it yourself, underwriting it yourself. Okay. Then there's the fund model, diversified model, and then there's what you do. I think the DIY approach, I can understand why that would be unfavorable, just because it's like a full-time job, like you said. Um, on the the method that Investaway does, the loans are 4 to 6 months, possible 2 month extension. So just say on average like 7 months, or or 6 to 7 months. So every 6 to 7 months, your money is getting returned to you, assuming everything goes well. Um, so there is some kind of like regular legwork that has to happen by the part of the investor for them to keep on putting in their cash. So I want to make sure that's true. But I'd say the trade-off I'm assuming then is you are getting your cash recycled, and you're probably getting higher returns because you're investing into individual notes. Is that correct?
That's exactly right. And so what we do with our self-directed IRA lending partners, there's a couple different options. Some people have checkbook control SDIRAs, and them, it's very easy. They can literally just like sign the agreements with us before the loan pays off, and then the money just rolls over to the next one. For those that have custodial accounts, we do have to return all the money to the custodian. They mark that investment complete, and then they can send it back to us. However, we will have all the paperwork for the loan that they're rolling into done in advance. That's what we coordinate with our co-lending partners. usually about 2 weeks out from when we estimate the loan's going to get paid off. Now, things slip plus or minus a few days sometimes, no problem. We will get everything set up. We'll send an email saying, hey, here's what your capital and interest is estimated to be on this date when it pays off. Here's a couple loan options that will take that money and based on your strategy that we've consulted on, based on your, will fit into your plan. If these look good, just hit reply and confirm, and we'll send you the loan docs to sign. So those get signed in the portal in advance. So then when that loan pays off, either the money just goes directly into the next loan, or of course we send it back to Camo Plan, then Camo Plan can just send it back to us because they've all completed trillion and it's all been approved. So it's a very fast turnaround, which is much better than like having to do it yourself, where your money might be sitting idle for weeks, months at a time while you're out looking for a deal and underwriting it.
Nice. And so when you said you basically start the loan document process or the investment document process 2 weeks in advance of the projected payoff. How far in advance are you? Well, I guess yeah, is the are investors typically looking at loans themselves already, or are you saying like, hey, you have a payoff scheduled in 2 months? Here are the loans that we have available, or how does that work?
It can be either way. So a lot of our investors, like their first one, they want to get real detailed. Once you've signed the co-lending agreement, we actually will share the full underwriting package on request. We don't normally share it, but you have access to that. Most investors, though, they're very hands off. They've, seen our slides, they look at a couple deals, and then they're just like, whatever loan you have, roll into it. Because again, all of our loans go through the exact same underwriting process. We have SOPs that go through for every single one. Um, if they want, we do make that recommendation. They can just reply and say, yes, confirmed. And then we send them the documents to e-sign and it's all set up in advance. Or they can say, hey, I looked at those. I really don't like that deal in Florida. I'd rather do one in Tennessee. Give me
Yep.
another option. They can then log into the portal. They can choose themselves, or I'll just run it through our system and give them another allocation.
Awesome. And I really like hearing how you're doing everything in advance. To that end, to all you listening, we're more than happy to make, as on behalf of Camelon, we're more than happy to help get the documents signed on our side too in advance, so it's all ready to go. We have our authorization form, aka the asset purchase directive. We're more than happy to work with you to get that uh, signed and taken care of ahead of time, so that we have everything on file. And once the capital comes back in, we can just turn it around, and usually we have a 48 business hours to wire the funds back out. So more than happy to do our part to make sure it goes smoothly. Um, One last question I had, I don't think I see any more questions coming in, is I think you said 75% max LTV. Um, what are the loan sizes and assets that you lend on?
Great question. So we lend primarily on single family homes. We'll do up to small multifamily on a case by case basis. Anything up to four is standard. Five plus will be a case by case basis. Typically, we're going to do a lot deeper underwriting, third party appraisals, things like that. Average loan size is about 250K. And so generally, looking at 2 to 3 investors, we have many investors that have like 500K plus deployed. And so they will take like those entire loans or like spread out across 2 to 4 loans, kind of like that slide I shared.
Beautiful. Perfect. Well, this is great. I really appreciate everything that you shared, and I like it even more that you were in Guatemala while you're sharing it. That's very, very cool. So, um, any closing thoughts before we end the webinar today?
No, really appreciate sharing this opportunity with you guys. Again, like scan the QR code or go to my Calendly there, whether you want to do it yourself or talk about what it would look like investing with us. Happy to have that conversation.
Superb. Again, thank you very much for your time, Harley. Really, really appreciate it. And for those of you who joined the webinar today, thanks a lot for taking some time from your afternoon or your morning if you're on the West Coast and spending it with the Camel Plan webinar. That will do it for today. We'll see you next week. Have a great day, everyone.